Hello and welcome to this session. This is Professor Farhat, in which we would look at audit assertions that are related to the sales cycle. So in this series of lectures, we're looking at the sales cycle. In the prior session, we looked at the introduction to the sales cycle, internal control. In this session, we would dive into the audit assertion related to the sales cycle. Now, those audit assertions, you could see them in other cycles, but in this session, it's how they relate to the sales cycle. So first, I'm going to list them: completeness, cutoff, valuation, allocation and accuracy, existence and occurrence, classification and understandability. Then I'm going to explain each one of them separately. Now, if you are using an audit textbook, you might see slightly different terminology. Slightly different. It could be you could be using international auditing standards. You could be using the PCAOB versus the AI CPA. So here I'm trying to keep it neutral in a sense that whether you are an accounting student or a CPA candidate, those assertions will apply to you, and if there's any clarification, I will make throughout. But I'm going to go over each of these assertions separately, explaining what the assertion is, what is its objective, and how to collect evidence, and which source documents are we looking at to achieve that objective. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Hello, my name is Farhat. You are here because you are either an accounting student, a finance student, or someone who's studying for their CMA or CPA exam. Great. You are looking for some additional help, and we can help you. I strongly encourage you to visit my website, farhatlectures.com. I offer additional lectures, resources, including PowerPoint slides, multiple choice questions, in some circumstances, exercises, and true-false questions. Our material is aligned with your CPA review courses, with your CMA review courses, with your college courses. I offer a risk-free trial that you can try to find out whether my website can help you or not. If you find it helpful, you subscribe, you keep your subscription. If not, you cancel and your risk is free. If you like this recording, if you like my lectures, you would like what's on the website, give me a chance to help you with your college courses as well as professional certification. I hope to see you on the website.
Starting with the completeness objective, the completeness assertion. What's the objective of the completeness assertion when it comes to sales? Simply put, we want to make sure that all legitimate sales during the audit period have been recorded and ensuring no omission of revenue. Now, generally speaking, if we are dealing with a publicly traded company, generally speaking, that's not an issue because they don't want to keep any revenue out. That's the assumption, is you want to report your revenue because you want the company to look good. So that's not really a huge risk when it comes to sales. It could be if it's a private company and they don't want to pay enough taxes for this year, they might move some sales. Nevertheless, completeness is making sure all sales transactions are included in the financial record, are actually in the financial record. Again, the risk is lower. It's less likely that companies keep sales out unless we are dealing with managers who are trying to defer sales since bonus was already earned. So what happens is, in some circumstances, let's assume this is period 1 and this is period 2. So what managers would do once they reach their sales target, which is they get their bonus, what they will do, they will start to defer some sales from year 1 to year 2, which is they violate the completeness. So any omitted sales could result in understatement of revenues, misleading stakeholders. So that's why it's a problem. So auditors pay attention to unrecorded sales by focusing on the population of the transaction outside the sales journal, such as shipping document and delivery goods. So how do we test for completeness? Well, we have something called directional testing, and part of it is something called the tracing. So let's look at how a transaction takes place. So here's how a transaction takes place. The customer will place an order. Then once the order is placed, we check their credit, we create shipping document, we ship the order, we duplicate the sales invoice, one we keep, one we send to the client, we record in the sales journal, then we record in the general journal, then the transaction goes to the financial statement. So it starts with the customer order all the way to the general journal. So what do we do? What do we have to do when it comes to tracing? We start with a customer order. And we say, okay, someone placed an order. Someone placed an order. Let's trace it to make sure that this order made it all the way to the general ledger and to the financial statement. So we would select a sample of shipping document. So from the sales order, we want to make sure, not sample, we would look at the shipping document and trace them to sales invoices, ensuring they are recorded in the sales journal. So a customer placed an order. Did we ship it? If we shipped it, did we create an invoice? And is the sale recorded in the sales order, in the sales journal? And obviously, if it's in the sales journal, it's in the general ledger. Now, in an automated system, means what? Means if the system is all interconnected, once a customer places an order, the shipping is made and the system is updated, it automatically makes it to the sales journal, the customer is billed, so on and so forth. But assuming that's not the case, we don't have an automated service. So if the auditor finds a shipping document with no associated sales invoice or journal entry, it may indicate an unrecorded sale. So simply put, if there's a shipping document here, we shipped something and there's nothing in the sales journal and we did not send a sales invoice, then it's an issue, because we did not, it means we shipped something, but there is no corresponding sales to that shipment, and it is a problem. If it's a problem if you ship something and you did not record it, it means you are not reporting all your sales. You have issue with your completeness. And how we test for completeness? Through tracing. So we'll take, either a shipping document or a customer order, usually a shipping document, because if you shipped something, it should be in sales. But the point is, you start from the beginning of the process and you trace it all the way till the end. That's the point, starting with the customer order. Remember, everything starts with a customer order. Let's look at the cutoff assertion. The objective here is to verify that all transactions are recorded in the proper accounting period, ensuring the financial statements, the revenue is correct. The cutoff focuses on ensuring that transactions near the period end are neither prematurely recorded nor delayed into the next period. So here what we're looking at is kind of, we have two periods, period 1 and period 2. And in period 1, we're in need of some revenue because we did not reach our revenue. We'll take some of the revenue in period 2 and we move it to period 1. Or the opposite, we'll take some revenue from period 1, we move it to period 2. Here we have to be familiar with the term FOB shipping and FOB destination. And I hope you remember this, the shipping versus the destination. And this is where the cutoff becomes important, because what you're looking at is this an FOB shipping? If it's FOB shipping, what does that mean? It means the buyer is responsible for the freight cost. It means the ownership and the risk of the good transfer as soon as the seller delivers the goods to the shipping carrier. Once I deliver it to the shipping carrier, the delivery truck or whatever, it's a sale. So the seller recognizes the sale at the point when goods are handed over to the shipping carrier, assuming they meet all the other revenue criteria. Destination, it's not revenue until it reached the destination. So this is why when it comes to the cutoff, we have to look at sales during that period to determine whether it's FOB shipping, FOB destination, because misstatement here can distort both current and subsequent period, because if you are moving something from this period to next period, this period and next period are misstated and vice versa. So timely recorded of transaction via a computerized system is less likely to contain those cutoff misstatements. So the cutoff is also part of the accuracy. Basically, when you are looking to see if it's recorded in the prior period, you're obviously going to look at the dollar amount as well, making sure the valuation, the accuracy is correct. But if you're using a computerized system, it would record it in the proper period based on the date of the transaction. So an auditor would review sales invoices generated just before and after period end and compare them with shipping and delivery date to confirm proper timing. So this is the entry. So post-year-end sales returns are also reviewed to identify whether the original transaction were recorded inappropriately in the prior period. They also look at the sales return to make sure it was actual sales. So if a company records a sale on December 31st for goods shipped on January 2nd, the transaction improperly inflated year-end revenue. because we did not ship it till January 2nd. It should not be recorded. The auditor will identify this by matching the invoice date with the shipment date and adjust the financials accordingly. And eventually we'll work an example that deals with this cutoff FOB shipping, FOB destination. So the cutoff is another assertion, and as I told you, as you're looking at the cutoff, you're also looking at accuracy and valuation, because as you are reviewing the document, you're also making sure all the figures are correct. Let's take a look at this multiple choice question from farhatlectures.com. In many audit, no substantive tests of transaction are made for which assertion on the ground that understatement of sales is not a concern. So which one is not, you don't really test for it. It exists, but you don't test for it. Is it accuracy? Oh no. Companies always make a mistake. You don't, especially whether it's sales or not, accuracy is important. So it is a concern. It is a concern. We're saying it's not a concern. Existence. Existence is always also a concern. If something exists or not, it makes a huge difference to the audit. So B is out. Completeness. When it comes to sales, understatement of sales. Understatement of sales, usually completeness is not a major concern. It's not a concern because companies, again, generally speaking, publicly traded companies, large companies, issuers, they don't understate their sales. If anything, the risk is for sales, it's overstatement, just like asset. The risk in asset is overstating asset, overstating sales. Therefore, completeness is not. So in many audit, no substantive of transaction are made for the completeness assertions on the ground that understatement of sales is not a concern. I mean, again, it could be an issue, okay, but it's not a major issue. It's not, generally speaking, it's not a major concern. Why? Because the bias, the risk is you're not understatement, the risk of sales is overstatement is the risk. Therefore, understatement is not a concern. What should you do now? You want to go to Farhat Lectures because you want to learn how different assertions applies in different cycles. So to do so, you want to work as many multiple choice questions as possible. Farhat Lectures can help if whether you are a student or a CPA exam candidate. I do have AI CPA previously released questions. Study hard and invest in yourself.